Historic events, technical events, the tectonic plates are moving, okay? And I think that a lot of assumptions that people have had about gold miners moving with the stock market or not with the stock market, since we last talked, for example, the last 2 years, most people in the sector are just bored or scared out of the markets, or two, bored to death, and think, oh, it's never going up. Well, sometimes these tectonic plates take a while. And I think that they're at a point now where the events will move quickly, far more quickly than we've seen in years, possibly ever. Okay, and I'm not trying to pound the table in some promotional way or something, but literally, I've never seen in my career such macro technical and fundamental events underway that the chief beneficiary of which should be gold and silver and the miners. Well, that's true too, but no, I would focus on the gold and silver miners. We know some of the other miners that beat the gold and silver miners, the base metal miners, for example. But don't look at that. I think we're at a point now where it's the monetary metals that are going to enjoy the move, not your base metals. Even with the base metals, some of them in short supply and in tight supply situation and so forth. But don't focus on that. It's a monetary crisis we're facing. It's been building for a long time. The central banks have created a monstrosity of a bubble in the U.S., most especially, more so than anywhere else in the world. Not China, not Europe. You look at their stock markets, what happened from 2009 to 2021. We went up, S&P went up sevenfold. NASDAQ went up 16, NASDAQ 100 went up 16-fold. You go back and look at bull market peaks that led to big bear markets in the U.S. stock market history, like 29 or the dot-com peak. But look at what happened before you got to the peak. What was the percent gain that you saw? Nothing compares to the sevenfold S&P over a dozen years, or 16-fold NASDAQ. So, and we know what caused that. I mean, you can chat all you want to about the fundamentals of this or that company, or demand for chips, et cetera, whatever. Look at an M2 chart. Look at a Fed funds chart. Go back 20 years and look at what happened. And you can see easily why the S&P went up sevenfold and NASDAQ went up 16. They created a river flow, a monstrous river flow. And they created it not just for a few years, but a dozen years. Over and over, repeated. Whenever they tried to deviate with slightly higher rates, they quickly snap them back down to zero. And now what they've done is come in with their rally to 5% on, Fed funds rate near 5%, is punch a hole in that bubble. And they thought they were going to punch a hole in, quote, inflation. And of course, they narrowly define and wrongly define what inflation is. Inflation is expansion in money units, quantity of money units. That flow goes somewhere. In history, we go back and look at various situations where they create a flow, and quite often it'll go into the stock market, like in 2009. Well, to some extent, that made some sense. The S&P had gone from 1570 into the 600s. Okay, and so they create a river flow, and so investors say, I'll put it in here. The risk is low now, and they were right. Okay, but then look at the late 70s. They created a river flow, and it didn't stop gold and silver from exploding, but stocks went nowhere. They were a wasteland until 1982. So there are times when the monetary events flow into an area that people aren't thinking about. Now, there's a lot of asset managers out there, not even gold bug types, big name people, I won't even cite who they are, you know who they are, who've said, hey, listen, don't pay so much attention to the price of your stock, pay attention to the underlying degrading value of your money unit. And a lot of these folks are saying, hey, gold is where to be. I could see the events coming, and they're still coming. I've not changed my macro fundamental or macro technical view. We turned bearish, for example, on T-bonds in late 2020, and they've collapsed since then. I think that collapse, by the way, is over. The stock market, we got bearish in January, February of last year, 2 months off the high, arguing that the downturn isn't a correction. It's the beginning of a major bear market, a deflation of a massive bubble. We still hold with that. But during that time, silver and gold had gone up, doubled, basically. Okay, gold had definitely doubled, 1,050 in 2015. By mid-2020, they doubled. Okay. Meanwhile, commodities had gone down during that time. So gold and silver went up on their own due to monetary factors. But then they went into this, what for gold turned out to be really, when you stand back and look at it, a congestion zone between the high 1600s and above 2000. Briefly pierced the bottom of that as a bear trap, hooked right back up to the top of the range now. Silver during that time had a corrective process, which was much longer lasting than we thought it might be. But we still defined it as not a bear market, but a corrective process when you look at the longer term trend. We think that's now over. the corrective process. We think we're now in the early phase of the resumption of what is, in fact, a bull market that began from 2015 lows. And if you go back and look at gold over the last 50 years, to give yourself some context, there have been 3 bull markets. One started in the early 1970s and ran to 1975 when gold was legalized here. Gold went from like $30 to $200. The 6-7-fold move. Then in 1976 to 1980, it went from $103 to $850, an 8-fold move. Okay. Then from 1999, it went from about $250 an ounce to $1,920 by 2011. A very long bull market, but an 8-fold move. Okay, so 3 times in 50 years, gold has produced basically a 7 or 8-fold move. So to argue just simply, based on what it's done before, almost routinely, we started from a low at 1,046, actually, intraday low back in December of 2015. We have only doubled since then. So you say, whoa, the big bull. No, it's minor compared to the 3 before. And look at the events that are surrounding gold right now. Monetary events, jeopardy of a lot of institutions that have basically taken the needle and put it in their arm for 12 years and had false investment and false assumptions about the cost of money. Hence have made errors. The errors are being exposed. And once those errors get exposed and institutions start to collapse and certain assumptions start to be proven wrong, namely that the Fed is on the right, is the leader of things, then suddenly you have a cold water smashed in everybody's face. They realize that, good grief, we made a mistake. And I'm going to suspect, and make you a bet, within the next 2 to 3 years, you will hear talk and possibly action about we don't need the central bank. Why not let money be priced by the free market like we do eggs or beef or grains or chips? Well, it could happen with an economic collapse and where people sit back and look at it. Already, you can see that some economists who are pro-Fed type economists and not anti-Fed, suddenly saying, hey, you guys have gone too far. Quit. Fed didn't quit, kept going for another couple of sessions, where some of these guys said, you've gone too far. You're going to create, well, sure enough, they get now look right. And they can stand up and say, we told you, Fed. So even some of the friends of the Fed have begun to inject doubt. And so it wouldn't shock me that the events create fracturing, a sense of, what did we do this for? It didn't work out. It's been 100 years of boom-bust cycles. Now we've created the biggest boom and now, therefore, the biggest bust in U.S. history with consequences attached to it. Now, our argument's been that once these asset bubbles break, and municipal bonds, high-yield corporate debt, stock prices, especially in the U.S., dollar demise as well, that will be the next wave effect that is probably right around the corner. Where suddenly you don't have any normal investment alternatives to go into. The 60-40 rule, 60% stocks, 40% bonds. Oh, you got a balanced portfolio, be in good shape. But last year you got killed with the 60-40. In fact, the bonds hurt you worse than the stock market did on a percentage loss, 21 to 22 close. So a lot of so-called truths and wisdoms have gone out the window. And a lot of asset managers and smart investors have said, hey, this doesn't work. What do I do? What do I do? Well, if you look at last year's action, and we used to post little simple graphs on year-to-date gains or losses in S&P, NASDAQ 100, muni bonds, et cetera. And you have these big negative bars on S&P and T bonds and so forth. And gold, 2021 close to the 2022 close, unchanged. 1820s. Silver, 2021 close to 2022 close, up 2 to 3%. Nobody realizes that, yet it was. Now, what did that say when all these orthodox portfolio components collapsed double-digit? No relief in the traditional portfolio components, and gold was unchanged. So even if you're not a gold bug, you're smacked in the face by that reality that, gee, I wish I'd been hiding in gold last year. And now this year, look what's going on. Gold's pushing back at the highs again. Silver's gone from a low near 17. It's now at 24 plus. Anyway, we think that the asset class shift into the monetary metals is underway because we think a monetary crisis has been exposed. It was created by the central banks. It's been punctured by the central bank policy. And once that balloon starts to implode, history shows that every time the Fed realizes shortly after a major bull market peak and you start to get downside in stocks and bonds or whatever, they start to shift rates back down again. But if you go back and look at the overlay of Fed funds chart, overlaid on an S&P, for example, you'll see that once those rates start to come back down, it doesn't help the stock market. It's too late. It helps it maybe a year or two later. During the initial phase of when the Fed says, oh gosh, we were wrong, it doesn't help. That money goes somewhere else. No, I don't think there's anything comparable. And I beat the table on that. I mean, it's simple. 7-fold move in the S&P over a dozen years, 16-fold in NASDAQ. Find me a bull market peak that was that bloated during a boom-bust cycle, monetary boom-bust cycle. You can't find one. I mean, even the 29 high, I think, was like a triple. Yeah, I'm saying that the rush to own a money, traditional money, been around for thousands of years, will be so great. Well, I mean, look what just happened. Back in January, for example, we looked at the bank stocks, MSA did. And we pointed out that in late January, the bank stocks were acting great. Okay, you look at them, they were one of the better performing sectors. Everybody was comfy with them because when the S&P made a low in June and had a rally and then took it out in October, and the NASDAQ did the same thing, banks didn't do that. They didn't make a new low. They held above the June low. And then they had the rally with the S&P into January of this year. And in late January, we warned, watch the banking sector. Nobody's looking at it. Nobody's thinking there's a problem here. We say technically it's ripe for something, an ambush is the term we used. Well, sure enough, 3 weeks ago, the ambush really began in a way that people noticed. Well off the January, February highs, it was in mid-March that this happened. So it was an ambush and nobody expected it. And so this is the kind of event that is monetarily connected. It's not a tech stock sell-off because they had too much gain relative to other stocks, and therefore, so they're buying tech stocks now because they look cheap. Well, heck, chip stocks got cut in half. Sure, they can rally more than the rest of the market because they were cut in half last year, but the S&P was only down 20%. So they're making the mistake of looking at the former leaders, the tech stocks, NASDAQ 100 components, and thinking, oh boy, it's a bottom. Meanwhile, the banks are falling off the page. And it wasn't just, by the way, the regional banks. You can look at the ETF for the regional banks and the regular bank ETF. And the KBE, the all bank ETF, is taking out the June lows too. And when you go to the banks that can't fail, what the big 4 or 5, and look at the price charts, the S&P is well above the June and the October lows. So is NASDAQ. But Bank of America and Wells Fargo are below the June lows. So all of a sudden they look one of the strongest components to where 2 of the big bank stocks are making new lows for the bear market. And Citicorp is not far behind. Citicorp's laying near the June lows and not far from its 2020 lows. So don't just look at the regionals and think, oh, it's just the regionals. Yeah, look at the big banks. Follow Bank of America, Wells Fargo, Citicorp, Goldman Sachs, et cetera. If you get even a rumor about a big bank, and we're hearing a lot of stories out there. There's been a lot of feed about some of these big brokers that also have banks. And some of them are well connected to big banks so that, if they ever had a problem, they'd be bought out by a big bank. So it's really not going to be a problem. But it's still something people weren't thinking about a couple months ago or even a month ago. Now suddenly they're ambushed by financial related declines. And things they didn't have to think about before, like, gee, I've got 400,000 in the bank account and that's over the 250 limit. I got to move some to another bank. God forbid you got 2 million, then you got to move it to 10 banks, or maybe you just make a phone call and buy some gold. And I suspect that's crossed a lot of people's minds when they were having to make this switch to balance their insurance protection in their bank accounts. The thought about gold, something they haven't thought about in a long time. And, Americans are really lagged on that issue compared to foreigners in terms of the friendliness to gold. And so if the American market ever suddenly wakes up and wants to buy gold, well, gold and silver are pretty small markets, and the miners are definitely a small sector. So can you imagine what'll happen if there's a sudden shift to realization? Gee, these things are behaving well. How come they're behaving well? They're not supposed to. The Fed's fighting, quote, inflation, which they narrowly define as commodity related. That's another issue. Well, in the real estate, I think I'd make it farming. Okay. You're buying an ETF on grains. We happen to think that the commodity explosion, that's what we termed it, coming commodity explosion in October of 2020. We put out a report. At that point in time, the Bloomberg Commodity Index was just above 70. It made a bear low in the high 50s. Okay, now put this in context. Its bull market peaks back in 2008 and 11 were well above 200, like in the high 200s. So we're dealing with something that had gone down into the 50s. So it had massively deflated. And in fact, during the time when gold went from 1,000 to 2,000, late 2015 to 2020, Bloomberg Commodity Index was still ratcheting down until late 2020, and it didn't turn up until gold had already doubled. So there was no correlation between commodities and gold. But when the commodities turned up, way before the Ukraine-Russia situation, which is in February of 2022, they doubled by the time that war started. And about a week or two after that war started, commodities peaked. So anybody who wants to blame the commodity explosion, and it was uniform. It was across the sector of commodities. It wasn't just energy. It was grains, it was sugar, it was copper, you name it. You could throw a dart. So it was overall commodity complex. Somebody said, hey, look, this is an asset category that is vastly underpriced. In fact, we called it theoretical zero, compared to stocks, which are 7 times or 16 times their prior pricing low, bear market lows. And the Bloomberg was at 280 or something in 2008 and 2011, and now it's at 50 something. So it made some sense for large asset managers to move into stocks that were related to those commodities. And of course, the energy stocks, fertilizer stocks exploded